So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. Guys, and welcome to another episode of the Investor Relations Podcast. I'm your host, Jonny Cattani, and I'm joined today by the amazing Travis Gibson. Travis and I met, have connected through Raise Masters, as pretty much all of my other guests so far. If you haven't learned yet, it's an incredible group we're a part of. And Travis is no exception. So Travis is an experienced real estate investor and managing partner of Freeman Equity with over 40 million in assets under management. He has 25 years of experience in real estate investing in several markets across the United States in both the residential and commercial spaces. He focuses on cash flowing assets to create significant passive income for investors. Travis, it's great to have you.
Man, it's great to be here. Thanks for having me on.
Absolutely. Yeah, I obviously alluded to how we met, and we're also in each other's accountability group, which is awesome. So we'll get to learn a lot about each other. So I'm excited.
Right on.
Cool. So before we kind of jump into Freeman Equity and everything you're working on today, let's kind of start at the beginning. What's your career been like up to this point, and what led you to real estate?
Okay, I'll take you all the way back.
Let's
people
do
say
it.
I look a little younger than I actually am. But, well, when I start telling the story, this will make a whole lot more sense. I come from a software engineering background, so I am actually a software engineer by trade, but now I manage other software engineers because I'm old, I guess. But I came out of college in '91. And I was getting killed on taxes. I'm out here in California, and the taxes are insane. So my parents were always single family investors, and my mother's actually a realtor. So her suggestion was, well, you need to buy a house because you need a deduction. So that was kind of the beginning of my real estate journey. So from 1992, I told you I was going to date myself. So from 1992 till 2008, I purchased 20 single family homes. I did flips. I did everything you can imagine in the single family space because that's all that I knew and that's all that my family knew. We had my parents had a nightclub, so there was a little bit of experience with commercial real estate, but only from a business perspective, not from a multifamily perspective. So I worked my career, and then I was a disgruntled landlord for the better part of 25 years, dealing with your normal tenants, toilets, and trouble. And literally, I've been through the ringer with tenants at different levels and going through all of the experiences. A quick caveat here, out here in California in the early 2000s, the laws changed in regards to marijuana cultivation. So you had this problem where people were renting properties and then converting them into marijuana grows. So creates a lot of damage to the property, and it's one of the things that I actually went through in my journey as well. So it was just a nightmare. But so fast forward to 2008, because I definitely don't need to take you through every saga that I went through. But 2008 was a very interesting year for me because the housing market essentially collapsed for all intents and purposes. So at that time, like a lot of folks, I had gotten pretty leveraged, and I'll never forget the day that Bear Stearns decided that they were no longer a solvent, and the subsequent collapse of my 80% of my entire portfolio. So So went through that, was able to transition out of it, caught the bottom of the market, was able to start rebuilding my portfolio. Got to the point where I had, 10 single family units again, and I hated it all along. Still working my full-time job, still full-time landlording. And a friend of mine who had actually, been through a very similar process, but he had actually invested as an LP in a multifamily deal. So he's started telling me about, how much better it was and how he didn't have the trouble of having to manage, with his tenants and do turns and all that stuff. And initially I thought, oh, sounds like a Ponzi scheme or some type of scam, right? What, better return, none of the trouble, doesn't make sense. So, at one point he gives me a call and I'm dealing with a new roof that I had to put on one of the units and then exploded toilet at another. He calls and I just happened to take his call and we started talking about some of the actual LP investments that he made. And at that point, I was convinced. I'm like, okay, you know what? I have a little capital. Let me deploy it into one of these deals, and let me see what happens. Right? I'm not from the show me state, but you got to show me. Right? You got to show me.
Absolutely.
I received my first ACH payment. I knew I would, but the reality of actually receiving it completely turned the switch on. I'm like, oh, okay, so this is actually real. Like, I'm actually going to get cash flow. I'm actually getting appreciation, and I'm investing passively. This particular deal, I got a 9% preferred return, and I'm looking at 2x multiple on a 5-year hold. I'm like, ooh.
Wow.
Yeah, I'm like, okay, so I need to do well. And just to give you some perspective, here in California, we're essentially an appreciation market, right?
Right.
The way it normally works is you have a huge amount of equity kind of just sitting in the property, but unless you refi it out and buy something else, you're really not able to tap it. And the rents, because of the current tenant laws, there's rent controls in place. So it's almost impossible to raise the rents to meet a reasonable return on your equity.
And this was the same back then too, like 08, 09, all that. Mm-hmm. This was all in place already as well.
But it's gotten worse.
Okay.
It was not great before, but in 2018 it got even worse because statewide rent control came into place. And you have things like you can't, even if you're on a month-to-month, you can't remove a tenant without cost. Like, and the only cause that you can have is two: breach of contract, and that includes non-payment of rent or complete, they're destroying the property. Those are your only two options. So other than that, they can stay in your property on a month-to-month basis for as long as they want.
Wow.
Yeah. And the only way to get out is either, like I said, either they breach the contract or you sell the property. It's the only way. Or you pay them to leave, which the cash for keys market has exploded too.
Yeah.
Where you're looking at a year of rent is kind of standard now to get a tenant to leave, which is insane. So I had rents that were $500 to $800 below market, and I had no way to actually catch up. So you're looking at 2 to 3% cash on cash per unit, and that's with me managing. I'm like, okay. And I had invested in a deal and I'm getting 9% and I don't have any of that. Oh, it was a no-brainer. So what I began doing is learning more about multifamily, learning more about commercial real estate. And I began taking equity out, selling properties, and redeploying it into other deals. And I'm like, oh, this is phenomenal. Okay, let me take it a step further, right? I've been in my career for the better part of 25 years. I'm looking to do something else at some point. So let me go ahead and see what the other side of it, the GP, the general partner side of it looks like. Talk to some folks at my company. One guy in particular had just gotten started with his transition. So we did our first deal in Kansas City. This was a $7 million deal. So for me, it felt huge, but I guess in the grand scheme of things, wasn't that big. But we actually put together a sponsor team. We took down the asset. And from there, it was bang, 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 bang. So we actually did 3 more syndications in 2020. And it took my total of units under management to over 500.
Wow.
So great. And this is during COVID, mind you. So from there, 2021, I'm starting to see a lot of cap rate compressions in my market. I'm starting to see a lot of competition with folks coming in looking for yield. So they're spending a little bit more than I'm comfortable spending as it relates to what my investors' expectations are.
Right.
So 2021, a couple of JV deals. That was pretty much it until close to the end of 2021, and ended up doing another syndication deal then towards the end of 2021. And now my current deal in Houston that's supposed to be closing week after next, hopefully. And that's a 227 unit deal. So with that deal, it'll push me over 800 units under management as a GP. And then on the LP side, because I still invest in good deals as just an investor as well, just because I love good deals, so far as LP deals, it's well over 3,000. So yeah.
That's awesome.
Yeah. So
you've since liquidated all the single family that's completely out of your portfolio.
Yeah. Yeah. I have no interest. The only one we have is the one that I'm in right now.
Okay.
And that's it.
And that's a pretty like standard story for, I feel like people getting into this space because like you said, tenants, toilets, trouble, the scalability is not there, right? Just, it took you, what'd you say? Like a little over 16 years to acquire what 20 units?
Yep.
Yeah. Now you have 500 in a third of the time. So
yeah.
So right there, I mean, that's a great proven story, why commercial real estate, why multifamily is really, it's recession resistant, it's such an incredible asset class. And I really love hearing these stories and yours is, I'm glad you made it through 08. I've had a couple guests, unfortunately, that didn't make it through 08. Stuart Heath, if you know him, unfortunately didn't make it through 08, but made it out and so awesome. So that's really, really a great story. And it sounds like, you're in a few other markets than just Kansas City. So is it just the Midwest and Houston or what other markets are you focused on right now?
Right now, I'm a big fan of Nashville and the greater Nashville area. One of the JV deals we did in 2021 was in Columbia, it's on the outskirts of Nashville. Not a fan of humidity. I'm from California, so I'm just going to be honest. Not a fan of that humidity, but these are growth markets. So I'm looking for markets where I can realize not only rent growth but also appreciation. So cash flow and appreciation. I'm looking for the consummate peanut butter and jelly for the deals I invest in, as well as the deals my investors invest in. I also like I'm a fan of Jacksonville. Got a deal there. I was big on Atlanta. I still am, but it's very kind of sub-market specific. Atlanta as an MSA is huge. I like Houston as well. Once again, similar situation. The MSA is gigantic. So just finding those individual submarkets, those pockets of value, I think are important.
Absolutely. And especially with this market, it sounds like you've already got it dialed, but those secondary and tertiary markets are really, especially if you're in the value add, which I know is your primary focus. That's really the only place you're going to find it.
Yeah.
Right now, unless you have incredible relationships with brokers, which of course we all know those deals are there even in these primary markets, but really this is where the trend is happening, and you're even starting to see it. The numbers are starting to show in terms of people moving there.
Yep.
These suburban multifamilies and people just wanting to get away from these primary markets and live. And it's a great time to be an operator in those markets. So that's awesome. And so with this, with the investors that you have, in your deals, are they similar story to you? You were able to kind of, obviously you had a network of people who were probably doing the same thing in the single family game. Were you able to kind of bring them out of that and help them realize, how much better subjectively it is in the commercial, or kind of talk to me, where you're finding your investors and how you brought them to your deals?
Great question. One of the good things about being in corporate America is you have an opportunity to reach out to a unsatisfied, untapped market a lot of times. Most folks working in W-2 are so time constrained that if they can do anything from an investment standpoint, beyond like stocks, they consider themselves fortunate. So what most do is kind of the same trajectory I took. Well, they buy a single family, maybe they buy another one. They realize that there's quite a bit of headache associated with it, and the ability to scale is limited. And then that they pretty much kind of peter out right there. Maybe they have a couple rentals and they call it a day. But what I was able to do is, at my company, we actually had a real estate investment club that anybody could present to. So once I got exposed to multifamily real estate, I'm like, oh, this is great. I should probably share this, right? And I know a lot of folks that are in my current situation where, for those that don't work in corporate America, they may not be aware, but there's a concept of golden handcuffs. Essentially, what these corporations do is they incentivize employees by giving them what's called RSUs, or restricted stock units. But these stock units vest, or you receive portions of them every year. So you don't get the entire vest at one time. What it does is it creates a situation where you're incentivized to stay longer than you normally would, because you never quite get the vest. The vest, in effect, never stops. So you get a new RSU allocation. It takes 4 years to vest. You get another one the next year. It takes 4 years to vest. So you're on this perpetual hamster wheel where you're running trying to get this vest that you can never obtain. So this is what happens. And this is because this is what happened to me. A lot of times you build up this pretty substantial portfolio of your employer stock. I work for Apple. Stock's been phenomenal. It's a great long-term hold. I hold it long-term. But I was in a situation where I had a pretty substantial Apple position, but it wasn't paying me anything. Like, I wasn't getting any cash flow. It would just sit there and I would look at it. It's like a video game, just numbers. Like, I don't see any. And because I had so much capital gains associated with that stock, that I knew anytime I decided to sell a portion, that between the federal government and the state of California, I was looking at close to 40% of my gains just goodbye. So I felt trapped. I couldn't sell. So I didn't feel like there was a way to really leverage that in order to get any passive income at all.
And the dividend yield, even when Apple had the dividend, was not very high, if I recall correctly.
It's like 2%.
Right.
I mean, it's great. I mean, it's something, but even that, I mean, it wasn't enough where I felt it moved the needle. So I would just reinvest that into Apple stock. I mean, why not? So once I got involved with multifamily and kind of burned through all the capital I had in the single family assets, I'm looking for additional capital to deploy, because in terms of not only your passive income, your appreciation, but also the tax benefits that you could enjoy from these investments, meant that for my personal situation, the income I was generating was, for all intents and purposes, it was tax advantage. I don't want to say it was tax free, but it was tax advantaged significantly compared to what my W-2 income was. So I was at this same real estate investment club presentation when another gentleman talked about, margin-based loans on equity positions. So for the layman, what this means is if you have a substantial stock position, there are brokers that will allow you to borrow against that equity position, and the fees, I mean, the interest is crazy low.
Crazy.
I actually use interactive brokers because they have the lowest interest rate on margin-backed loans than anybody else. I think right about now it's under 2% still.
Wow.
So you're able to, for a position that you're going to hold long term anyway, you're able to borrow a percentage of that equity, and then in turn deploy it into other deals, generate passive income, use a portion of that passive income to service the debt, keep the delta. I'm like, oh.
So it's essentially a HELOC against your Apple shares or whatever
Yep.
stock shares you may have.
Yep. Yeah, and
Awesome.
and typically you're gonna stay under 50% of your current portfolio balance.
Right. So you're not going to get as much as like a home, like your home equity, just because a little more volatility of the stock market. They have to bake in some of that equity drop and things like that. Okay. Awesome.
Yeah. And you certainly wouldn't want to be over leveraged either.
Of course.
I mean, that's important.
Absolutely. And so what kind of deltas were you looking at typically?
Oh man. Okay. For me, I tend to be, to err on the safer side. So, I was looking at I would get 40%. I'm about 40% right now. And that's even after the market pullback. And, from there, 6-7% after fees. Yeah. Yeah. And this doesn't even take into account any of the appreciation that I actually enjoyed on any of these investments that I made. That doesn't even, I'm talking strictly cash flow.
Wow.
So, once I began talking to your question, once I began telling, other folks about, I'm like, look, you're in this situation similar to me. This is what you can be doing right now. The whole FIRE initiative, financial freedom, retire early. It's pretty popular in the technology field as well. There's a lot of people that kind of are looking for that. I'm like, this is an opportunity for you to leverage what you have long term, generate cash flow right now, that if you want to decide that that you've had enough with the corporate rat race, you can leverage that to get to that point. So, from there, and like anything else, once people see you having some modicum of success, it's when they really start to come.
Absolutely.
So, I get folks all the time now, hitting me up because they've seen, they see me doing this for the past couple of years, and I haven't, I haven't really needed to. I'm getting to that second and third level investor at this point. Folks that have already invested with me are telling folks about people about investing with me.
Wow. That's awesome. So you've gotten to the point now where, pretty much referral based in terms of bringing your investors, and obviously, so you're still at Apple, if I understand correctly. Okay.
Yeah.
So most of what you're leveraging is Apple, which of course is, blue chip. I have a ton of Apple in my portfolio as well. I was a stockbroker for a long time, and so I remember the early days when Apple was way down there, and that was great to get in, that. But again, like you're saying, your cost, it's great to have that low cost basis,
right?
But either way you look at it, I'm sure long-term capital gain going to be typically a much lower rate than short-term, but still it's a capital gain, and it's up 15, even maybe 20%, depending on your bracket. And that's significant. And so when you can take advantage of these things and, continue to leverage and, correctly, conservatively, what you're doing, and use that and deploy that. And this is a true example of really making your money work for you at all hours. And, that's really what this is about and why we do it. You know, I mean, of course, selfishly, it's great to make money, but
Right.
being able to help people, like you say, break free of those golden handcuffs. And I can only imagine the feedback you're getting, especially if you're to the second and third level of investor. So I guess now kind of talk to me about, you know, Freeman, your capital group and, you know, what you guys are doing and how you started and where you're headed.
Right on. So I started Freeman Equity in 2019. I realized that I was really interested in finding alternative investment vehicles for not only for myself, but for, you know, the people in my circle. And it's kind of developed from there. You know, my primary focus, my initial focus was multifamily. And I think multifamily is always going to be my first love. But I've even gotten to the point now where I'm starting to look at, you know, different asset classes, even within the commercial real estate space. So, you know, we're looking at self-storage deals right now. We're looking at mobile home deals. I want some more exposure across the commercial real estate space. I'm even looking at doing a crypto fund at this point. So I think our transition will ultimately be, you know, from being initially multifamily based into more of a private equity model where, you know, we are able to kind of gather in these different types of asset classes and present them to investors, you know, vet them, provide value around these individual asset classes, and then, you know, from there, manage money at that point. So I think that's kind of our progression. But like I said, multifamily will always be a core part of what Freeman Equity is, just because, just on a risk-adjusted basis, it's such a stable and just quality asset class. Like I never thought I would be in a position where I would have this much of my overall net worth in multifamily. If you'd asked me 5 years ago, I never would have saw myself in this position. But knowing what I know now, it's a move I wish I'd have made 10 years ago. I certainly wish I had made it before 2008. If I had made it before 2008, we were probably not even having this same conversation. So
Absolutely. That's awesome. So yeah, like you said, I mean, it's the tried and true. It's such a core. It's really a great core for your portfolio because, you know, for those that are new to the space, the way that, you know, commercial real estate, commercial multifamily works is that it's more based on the cash flow of the asset and what the asset produces, and not necessarily like residential where it's based on, you know, what's selling around it and just the price of the asset in general. So that, you know, allows you when, you know, we're headed towards you know, no one knows when the correction's coming or what even is going to happen, but we are headed in that direction, and that's starting to become, you know, top of mind for people. And this is really that asset class that can shield you from that, as well as inflation, hedge against that as well. So really an awesome, you know, core piece of the portfolio. And then have you thought about potential full circle and maybe some venture capital into some tech startups and things like that?
yes. I still have a pretty substantial risk tolerance. It's not as big as it was, but it's still pretty big. You know, I've actively traded options for I don't know how long, as well as, you know, I invest in a lot of crypto projects. So yeah, I've actually been in conversations with a few folks around maybe doing some angel investing as well. You know, it's one of those things where I'm trying to focus, but my ADD keeps kicking in, and I see so many different options that, you know, the gambler in me says, okay, you know what? Now that we kind of have our core positions in place, let's look for some asymmetric returns. Let's shoot some shots, and that's what's kind of happening. Here's a quick story. I had a chance to to actually pick up some SpaceX.
Oh, wow.
Yeah, in the private equity market. And I could have picked it up for under $200 a share. The only reason I didn't do it, and this is my mistake, not understanding the way in which that private equity market works, because I would have had to pay a 20% VIG on the private equity shares once they went public. I'm thinking, oh, no, there's no way I'm going to give you 20% on the pop once this thing goes public. Doesn't make sense. Come to find out, that's how they all work.
Wow.
Well, and now, those same SpaceX shares in the private market right now over $700. Who knew? I didn't know. So,
yeah. Well, I mean, that's I was a stockbroker for a long time, and unfortunately, lessons in that area cost, and not necessarily you lose money, but you miss out on money. But guess what? You don't make that mistake again next time.
yeah,
You
who
see
knew?
those same indicators, or you get that same opportunity. But that's kind of the risk you take with that. And of course, venture capital is we could talk forever about that, but you got to invest 100 times to get your one unicorn. So it's definitely, you got to have a higher risk tolerance, which is why they're usually billionaires.
Yeah. Well, you get these moonshots. I was an early Tesla investor. I ended up taking profit, which is, it is kind of my moniker now. Like, take profits or don't is like my hashtag.
I like that.
But what I did is I had a pretty substantial Tesla position that I held forever, and it wasn't doing a whole lot. I sold some of it, and then once I started seeing what was happening in 2019, I actually reestablished that position, and it worked out really well. But it's one of those things where, to your earlier point, you kind of have to go through it to understand.
Right.
Because I had seen kind of what's possible when a company. I'm not gonna Tesla fanboy you, but needless to say, from that run up, I bought a Model Y, paid off my mortgage. It gave me a lot of capital to invest in multifamily, and I was able to hold on to most of the position. Although it's one of these hindsight things.
Right.
If I had held the entire position, we're probably not having that conversation again.
I know. So, and I kicked myself over Tesla too, because I played with it for a while back when it was, up and down, and I completely got rid of it for some other things. And I'm back in it, and, I have a great gain, but, of course, that hindsight, you're like, oh man, what could have been? Yeah. Well, I wish we could keep talking forever, because this is certainly what I could talk about for the end of time. But we'll get into the final 5 questions here. Same questions we ask everybody. First question, best advice you've gotten from a mentor?
A gentleman named Bill Ham in the multifamily space. He said, don't worry about unit count, worry about equity.
Okay, I like that a lot. Wow. That's awesome. That's just right to it. Huge. All right, next question. A recent time when you faced adversity and what you learned about yourself.
I face adversity all the time, but I think the crowning moment for me was 2008. Being able to crawl out of the ashes and put together what we currently have now. It was a lot of work and a lot of stress, but it's something I'm super proud of.
Awesome. I love that. Favorite non-real estate or investment related book? Oh, he's got it right there. Oh man.
Who Not How. This has been a game changer for me. Being an engineer, and I'll make this brief. Being an engineer, I want to do everything myself, and understanding that is not the best use of my time has been huge.
Yeah, even if you can do certain things, there's just some things, like you said, that really are not the best use of our time.
Yeah.
And we got Who Not How from, I was part of joining Raise Masters, and really complete game changer. I'm hiring VAs and, just leveraging people who have, can do this stuff so much, honestly, better than I can.
Better. Mhm.
Truly. All right. So my favorite question, if your personal investor avatar was a Marvel superhero, which one would you be?
I want to say the Hulk, but more than likely it's probably going to be Iron Man, only because I'm a risk taker by nature, and I think Tony Stark is the consummate risk taker.
Absolutely. Great one right there. Awesome. And then last question, what's the best way for people to get a hold of you and learn more about you?
On all of the major social media platforms. That's Facebook, Twitter, LinkedIn. On LinkedIn, I'm Travis Gibson, or you can go to Freeman Equity. On Facebook and Twitter, it's at Freeman Equity and Freeman Equity respectively. On Instagram, it's Freeman Equity. You can reach me via email at travis@freemanequity.com. And I'm around. So
awesome. We'll link all that in the show notes. Travis, this has been an incredible conversation. I definitely would love to have you on again later on and see how both of our businesses have progressed. It's always fun to check back in, and I'll be talking to you here shortly in our accountability group.
Right on. Looking forward to it.
Absolutely.
Thanks.
Have
man.
a good one. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.